Curious about the stock market, but don't know where to start? You're not alone, and you're in the right place. In this beginner's guide, we'll break down the basics of investing in simple, easy-to-understand steps. No jargon, no pressure, just the essential tools you need to start building your wealth with confidence. Let's demystify the stock market together. Today, we will talk about Beginner's Guide to Stock Market Investing. So before we start, make sure to hit the like button and subscribe to my channel. 1. What is the stock market? The stock market is where investors buy and sell shares of publicly traded companies. Think of it as a marketplace, like Amazon, but instead of goods, you're trading ownership in businesses. When you buy a stock, you're purchasing a small piece of a company, known as a share. If the company grows and profits, your shares may become more valuable. The main U.S. stock markets include the New York Stock Exchange, NYSE, and the NASDAQ. Companies list their shares on these exchanges through a process called an initial public offering, IPO. Stocks are traded daily, and their prices change based on factors like earnings reports, market news, and global events. The stock market is essential to the economy, providing companies with capital and investors with the chance to build wealth over time. For beginners, understanding what the stock market is and isn't is the first step in becoming a confident and informed investor. 2. Why invest in the stock market? Investing in the stock market can be one of the most effective ways to grow your wealth over the long term. Historically, the stock market has delivered an average annual return of around 7 to 10% after inflation, outperforming savings accounts, bonds, and most other investments. While the market can be volatile in the short term, it generally trends upward over decades. This makes it especially attractive for retirement planning and long-term financial goals. Compounding is another powerful reason to invest. Reinvesting your returns allows your money to grow exponentially over time. Stock investing also offers liquidity, meaning you can easily sell shares and access your money if needed. Beyond financial returns, investing helps you become more financially literate and engaged in the broader economy. It gives you partial ownership in innovative businesses, from tech giants like Apple to retail leaders like Amazon. The sooner you start, the greater your long-term growth potential. 3. Understanding stocks and other investments. Stocks are just one type of investment. A diversified investor might also own bonds, loans to companies or governments, mutual funds, pooled investments managed by professionals, ETFs, exchange-traded funds that track indexes, and REITs, real estate investment trusts. When you buy individual stocks, you're betting on specific companies. With ETFs or mutual funds, you're spreading risk by investing in many companies at once, ideal for beginners. Stocks are categorized in different ways: blue-chip stocks, large, stable companies; growth stocks, fast-growing but riskier firms; and dividend stocks, companies that pay out profits regularly. Understanding these categories helps you tailor your portfolio to match your goals and risk tolerance. Beginners often start with index funds, or ETFs, like the S&P 500, which tracks the performance of 500 major U.S. companies. Knowing the differences between asset types gives you more control and confidence in building a well-rounded, long-term investment strategy. 4. How to start investing. Getting started is easier than ever. First, open a brokerage account, an online platform that lets you buy and sell stocks. Popular brokers like Fidelity, Charles Schwab, Vanguard, Robinhood, and E*TRADE offer user friendly interfaces, zero-commission trades, and helpful tools. Once your account is open, transfer funds from your bank and begin researching what to buy. Many beginners start with ETFs or index funds, which offer diversification and low fees. You don't need a lot of money. Many platforms allow fractional shares, so you can invest as little as $5. Set clear goals. Are you investing for retirement, a home, or long-term wealth? Know your risk tolerance and time horizon. Begin slowly, focus on learning, and avoid trying to time the market. Consistency and patience are key. Many successful investors use dollar-cost averaging, investing a fixed amount regularly. regardless of market conditions. This reduces emotional decision-making and takes advantage of long-term market growth. 5. Understanding risk and reward. All investments carry some degree of risk. The key is balancing that risk with potential rewards. Stock market risk includes market volatility, economic downturns, inflation, and company-specific issues. The higher the risk, the higher the potential return, but also the greater the chance of loss. Younger investors can usually take on more risk because they have time to recover from downturns. Older investors may prefer safer, income-generating assets like bonds. Diversification is the best tool to manage risk. Spread your money across sectors, industries, and asset classes, so no single investment can sink your portfolio. Also, never invest money you'll need in the short term. 6. Avoiding common mistakes. Beginners often make avoidable errors that cost money and confidence. One major mistake is trying to time the market. Predicting highs and lows rarely works and usually leads to buying high and selling low. Another is investing without a plan. Without clear goals or risk tolerance, it's easy to panic or chase trends. Overtrading or constantly buying and selling can rack up fees and taxes, hurting returns. Falling for hype is also common. Just because a stock is trending on social media doesn't mean it's a smart buy. Beginners also sometimes invest too much in one company, ignoring the benefits of diversification. Others wait too long to start, thinking they need thousands of dollars. The reality: small, consistent investments often outperform risky, large ones. Always do your own research and avoid emotional decisions. 7. Long-term investing strategies. Long-term investing is the most reliable way to build wealth in the stock market. One key strategy is buy and hold, purchasing quality investments and keeping them for years, even through market downturns. This approach minimizes taxes, trading costs, and emotional decision-making. Index investing is another proven method. By buying broad market ETFs like the S&P 500 or total market funds, you gain exposure to hundreds of companies at once, ensuring built-in diversification. Many successful investors also use dollar-cost averaging, which reduces the impact of market swings by investing the same amount at regular intervals. Reinvesting dividends is a subtle but powerful tactic. Using your earnings to buy more shares accelerates compounding over time. Setting up automatic contributions through your brokerage or retirement account helps you stay consistent. 8. Tools and resources to learn more. The more you learn, the better your investing decisions will be. Start with classic beginner-friendly books like The Little Book of Common Sense Investing by John Bogle or The Intelligent Investor by Benjamin Graham. Online platforms like Investopedia, NerdWallet, and The Motley Fool offer educational articles, tutorials, and courses. YouTube channels and finance podcasts can also provide valuable insights, especially for visual or auditory learners. Many brokerages offer free research tools, simulators, and webinars. Use them to practice and build confidence. Consider joining online communities like r/investing on Reddit or bobbleheads.org for real-world advice and shared learning. Be cautious about advice from influencers or social media. Always verify information through trusted sources. Remember, the goal isn't to become an overnight expert, but to steadily build knowledge and experience. With consistent learning and practical application, you'll become a smarter, more confident investor prepared to make decisions that align with your long-term financial future. But if you like this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.